Welcome to the challenge and the last video of this chapter. And what a question it is. It is very brilliant and good question. Considering the table, which is the most volatile bond? Bond A, bond B, bond C, and bond D. In the table, we have yield to maturity and coupon rate. We haven't talked about bond volatility because we do have this topic in future chapters. But for now, just remember this. We're gonna talk about yield, like equity volatility and bond volatility in details in future chapters, okay? I promise you. But remember this about bonds. Typically, bonds with lower coupon rates are more sensitive to changes in interest rates, as the fixed coupon payments represent a longer portion of their overall return. And bonds with longer maturities are also generally more volatile. So, when it comes to volatility of the bonds, volatility of the bonds with lower coupon rate and longer maturity, longer maturities are more volatile, okay? Why lower coupon rate? Let's say the bond gives you 2%, okay? And something like COVID happens. You see interest rate nowadays in August 2023. I'm not sure when are you watching this video, but in August 2023, the mortgage rates the interest rates, prime rates are 5%. It's a lot, okay? Let's say you have bond with 2%. It's not a good idea to buy bonds because GIC is offering 4.5% out there right now. Yours is 2%. So if your bond coupon rate is 2%, it's more volatile. It's more. It's not a good thing for you. You know, it's more volatile. But if your bond coupon rate was up like 7%, you didn't care about the coupon rate, about the interest rate out there. Term to maturity. If the term to maturity is longer, it means there are lots of time that interest rate can fluctuate. This is not good for you. Okay? The bond shouldn't have this much of time. So the longer the maturity, the term of the bond, the more volatile the bond is. But again, we will cover bond volatility and equity volatility. There are different terms like duration and standard deviation that we will cover in future chapters. So don't worry about it right now, okay? Just remember this: lower coupon rate and longer term to maturity. And I need to say that congratulations, you finished chapter 7. And it was a very good chapter. And we've covered very important topics. You're going to get lots of questions from just this chapter. So please, if you haven't absorbed it, like fully absorbed it, fully understood it, please review it again. Okay, you got lots of time. And yeah, I am proud of you. You are crushing it. So I will see you in chapter 8, and please take care of yourself. Welcome to challenge number 1. What factor does the real rate of return take into the account? A, inflation rate. B, standard deviation. C, geometric mean, and D, arithmetic mean. We know that real rate of return equals to nominal rate minus inflation rate. So the right option is A, real rate. Consider that inflation rate. Okay? This was very easy question, but you may get these types of even easier questions on your final test. Okay? Let's get to the second challenge of this chapter. Welcome to challenge number 2. Which method can analysts use to measure the risk of an equity investment? A, arithmetic mean, B, standard deviation, C, alpha, and D, duration. We know that for the right answer option is option B, but why? We know that for equities, we use standard deviation and beta. And for bonds, we use duration, coupon rate, and term to maturity. Great. And yes, you have finished chapter 8. Congratulations. You're doing great. I'm proud of you. And I think we have covered everything. Trust me, everything of chapter 8. You're not gonna get surprised or be surprised and get like unfamiliar question on your final test. I promise you. Stay healthy, stay happy, and smart, okay? I see you in chapter 9. So take care of yourself. Welcome to challenge of chapter 9. Okay. In this challenge, this is not multiple choice question. We do have a table on the right. Okay, let's read the question. Why am I like describing the challenge? Let's read the question first. Considering the table, calculate the current assets, fixed assets, gross profit, net profit, shareholders' equity, retained earnings at the end of the year, all liquidity, operating performance, value, and risk analysis ratios. So, when I say you will have financial statement of a corporation on your hand, I mean they will give you a table like this. Not like in yellow color, but I mean the terms that you will see on the financial statements are the same as it is in this table. Whatever formula we have learned in this chapter, okay, this challenge is asking you to calculate them. Whatever formula, using just these, the information or data in the table. I provided the answer, but please try to. I already said that you need to memorize all of the formulas. Okay, you need to memorize them. Then this like for this challenge, try to do and calculate all of those terms yourself first, and then match your answer with the answer provided here. Okay, the answers are great. This is the end of chapter 9. And yes, we did it. We covered 50% of IFC exam and IFC textbook. And I'm proud of you. You're doing incredibly good, okay? So, I see you in chapter 10. Till then, take care of yourself. Stay healthy, stay safe, and try to smile. It was a fake smile, but I mean, you get the point. See you in chapter 10. Welcome to challenge number 1. Nizila recently joined XYZ Bank and will be responsible for providing investment advice to clients. Congratulations, Nazila. If she is also authorized to sell mutual funds through an affiliated investment firm, how would her licensing be categorized? What a question. A. Registered dealing representative at XYZ Bank. B. Registered dealing representative at the affiliated investment firm. C. Fund manager at XYZ Bank. And D. Fund manager at the affiliated investment firm. So, Nazila is working at XYZ Bank, also registered, also working for the affiliated investment firm. They're selling funds for them too. When licensing, she need to go through licensing, okay? Which of these corporations are responsible or firms are responsible for Nazila, and what's the title of Nazila should be? The right option is option B. Nazila is registered dealing representative at the affiliated investment firm. But why B? Let's read that white text on the bottom. Mutual funds are distributed through a number of channels by dealing representatives employed by investment dealers. So, option C and D is eliminated because Nazila's role will be mutual fund sales rep, okay, dealing representative, mutual fund registered dealing representative, not fund manager, okay. Then, a representative employed by investment dealers, mutual fund dealers, and to a lesser extent, exempt market dealers. Mutual funds can be distributed through sales forces employed by organizations that control both management and distribution of mutual funds, etc., etc., etc. And let's read by dealing representative employed by dealer who are affiliated with financial institutions, employees of trust companies, banks, or credit unions who are employed both by the financial institution to provide banking and related services can also be registered as dealing representatives for an affiliated but separate mutual fund dealer. This is extracted from Google textbook. There were different sources to find the right answer, but here is the exact text for you. So the right option is option B. Let's get to challenge number 2. Challenge 2. In which disclosure document would ABC Asset Management most likely disclose the change in compensation for officers and trustee of their equity mutual fund? A. National instrument. B. Annual information form. C. Fund fact. And D. Simplified prospectus. We said that whatever related to salary, compensation, and bonuses are covered in option B, AIF, or Annual Information Form, which is available on SEDAR, just like financial statement. So this is again the type of question you may get on your final test from those documents, okay? We didn't have question on the bottom of that slide, the different documents related to mutual funds. Here is that question, okay? Here is the type of question you may get from different documents. Great, let's get to the last challenge of chapter 10. Where can an investor find documents such as annual information form, audited annual and interim financial statement, and an annual report? A. IIROC. B. NRD. C. OSC. And D. SEDAR. And we both know that the right answer is option D. AIF and different financial statements and annual reports are available for you on SEDAR. And yes, we have completed chapter 10. You are doing awesome. I'm proud of you. So, I will see you in chapter 11. Till then, stay healthy and stay safe. Take care of yourself. Welcome to challenge number 1. We're gonna have 3 challenges for chapter 11. Nav strongly believes that the Canadian economy will experience significant growth over the next 5 years. In terms of tax efficiency for investment held in a non-registered account, which of the following mutual fund would be the most suitable choice for NAV? A. Preferred dividend fund. B. Money market fund. C. Bond fund. And D. Mortgage fund. This question is, not for this chapter, like exclusively, because we had this talks about the tax and tax treatments. We had dividends, interest, income, capital gain. But since we covered conservative mutual funds, I myself on purpose put this question for this chapter as well. The right answer is A. Preferred dividend funds. Why? Because there are we gross up the dividend, and then there are some dividend credits, tax credits for dividends. That's why it's the most tax efficient fund for our investment. And remember, it says Canadian economy will experience significant growth. Yeah. So it's preferred dividend funds, because the term to maturity also makes sense. For money market funds, it's just less than 90 days. So it doesn't make sense. It's the money market funds are less than 90 days. But the question says NAV is confident that the economy will grow up in the next 5 years. So this is the way to eliminate the options. But we know the tax treatments on different interests, different dividends, capital gains. Great. Let's go to the challenge number 2. Welcome to challenge number 2. What strategy do fund managers employ to make a bond portfolio less sensitive to interest rate changes when they anticipate a rise in interest rate? A. Increase the duration of the portfolio. B. Replace short-term high coupon bonds with longer-term lower coupon bonds. C. Shorten the duration of the portfolio. And D. Replace long-term low coupon bonds with shorter-term higher coupon bonds. Remember, when interest rate goes up, bond price goes down, and vice versa. When interest rate goes down, bond price goes up. Here, we are talking about a bond portfolio, so interest rate matters, okay? When we're talking about the effect of interest rate on bond, what's the first term comes to your mind? Of course, duration, okay? So, it's either A or C. We just eliminated with options B and D. It's A or C. But why C? Let's read the white text. When fund managers anticipate a rise in interest rates, they aim to reduce the sensitivity of the portfolio to interest rate changes. Okay? Shortening the duration of the portfolio achieves this objective. By replacing long-term, low-coupon bonds with shorter-term, higher-coupon bonds, the portfolio's duration decreases, resulting in a reduced interest rate risk. Shorter-term bonds are less affected by interest rate fluctuations compared to longer-term bonds, and higher-coupon bonds provide more income to offset potential price declines. So, if the duration of the portfolio decreases, it means the percentage change of our bond is less. Okay, because duration shows a 1% change in the bonds price with a percentage change in bonds price with 1% change in interest rate. If we reduce that duration, okay, it means the interest rate has less effect now. Great. Let's get to the last challenge of this chapter. Challenge number 3. Using the table, respectively, what is the approximate current yield and effective yield of the ABC money market fund after day 7, assuming the initial investment was $25 million? So the first number is for current yield, and the second number is effective yield. We know the formulas, okay? Please calculate it yourself, okay? And then check the answers with the right answer that I'm gonna provide. The right option is option D, but how 7-day yield equals to 25 million and 14,970 divided by 25 million, the whole equation minus 1, okay? And the current yield is 7-day yield multiplied by 367 divided by 7, which will lead to 3.12%. And the effective yield equals to 1 plus 7-day yield to the power of 365 divided by 7 in the whole equation minus 1, which is 3.17%. And a cool point here, remember we said effective yield is always greater or equal to current yield. Just from knowing this concept or statement, we can eliminate option A and option C. It's really beautiful. You were down to just option B and D, and if you didn't know the formula, you can just do it randomly, and your chance were like 50%. Great. This is end of chapter 11. I'm proud of you. You are doing great. And trust me, we have covered. You think like we didn't cover everything in chapter 11 just because there were 2 slides to learn? No, we have covered everything, ins and outs of chapter 11. And you saw the different types of question you may get on your final test from chapter 11. And we are reaching to our goal, okay? We will be finishing the whole textbook soon. So, I'm going to give you a big plus and congratulations. I'm going to see you in chapter 12. Till then, stay safe and healthy, and take care of yourself. Challenge of chapter 12. A client who holds a natural resource fund exclusively will most likely be exposed to what type of risk? A. Interest rate risk. B. Foreign exchange rate risk. C. Liquidity risk. And D. Lack of diversification risk. And the right option is option D. But why D? We talked about it. Specialty mutual fund. Okay, specialty mutual fund means just holding one security related to just one industry. You're being just special. Okay. Specialty mutual funds main type of risk is lack of diversification. You need to have different types and different industries in your portfolio. And great, this was a very good chapter. It was short, but we learned a lot. Okay, this is end of chapter 12. I'm gonna see you in chapter 13. So till then, be healthy, be positive, and energetic. Okay, take care of yourself. Challenge number 1. What contributes to the complexity of calculating the adjusted cost base of mutual funds? A. Adding the costs of reinvested fund income to the original costs of the fund. B. Difficulty in tracking the original purchase price due to multiple securities. C. Varying tax rates for mutual fund investors each year. And D. Changing securities held in the fund from the time of the purchase to redemption. This is very, very, very good question. Very important one. This question is talking about the main difference of the closed-end funds and mutual funds or open-end funds. The right option is option A. Why? Because with closed-end funds, okay, if the investor earns any income, dividend income, interest income, whatever, the closed-end funds give it directly to investors. Investors can't reinvest that income and buy extra units because units are fixed in closed-end funds. With mutual funds, on the other hand, investors again get income, but most of the investors, they reinvest that money to buy extra units. Now, adding the cost of reinvested fund income to the original cost of the fund is a challenge with the mutual funds. That's why option A is correct. Great. Let's get to challenge number 2. Challenge 2. How will the death benefit be determined for an investor who passes away 2 years after purchasing a 10-year term segregated fund with a 75% death benefit and maturity guarantee? A. The death benefit will be denied as payment. B. The death benefit will be paid based on the current market value. C. The death benefit will be issued as the full amount of the initial investment. And D. The death benefit will be disbursed as the death percentage minus the market value. And the right option is option D. Why? Let's read that white text. The principle behind the death benefits is that the contract holder's beneficiary or state will receive payouts amounting to at least the original guaranteed amount. The amount of the death benefit is equal to the difference, if any, between the net asset value of the fund and the guaranteed amount. This is copied exactly from textbook. Great. Let's get to the last challenge. Challenge 3. Which managed product is the best choice for an investor aiming to buy a home in the next 4 to 6 years? A. Segregated fund. B. Principal protected notes. C. Hedge fund. D. Exchange traded fund. The right option is option B, PPNs. But why B? Because it is protecting our principal. Simple. But let's read that white text. The reason is that a PPNs is designed to provide protection for the invested principal amount, offering the potential for returns based on the performance of the underlying asset or index. In this case, since the investor is planning to purchase a home within the next 4 to 6 years, preserving the principal becomes a priority. PPN offers downside protection and ensures that the investor's initial investment amount is protected, which makes it a suitable choice for this specific investment goal. And also, PPNs are has a mediocre between the alternative managed products. PPNs has a mediocre return, not just low return. Okay, and it makes more sense to buy PPNs if your goal is buying a house. And this is end of chapter 13. We did it. I'm gonna see you in chapter 14. Till then, take care of yourself and be energetic. Bye-bye.